Jim Rickards, Don't miss the signs of another slow-motion meltdown. Are we in a slow-motion meltdown? Are markets telling us a global liquidity crisis is on the way in 2019? Jim says the signs aren't encouraging. If you've ever lived through a life-threatening emergency, whether a car crash, train wreck, or a steep fall, hopefully not, you have noticed that time seems to slow down. You witness your personal jeopardy in slow motion. A memorable example of this is the film The Matrix, in which the hero, Neo, could dodge bullets since time moved in slow motion for him. According to the best science, time does not actually slow down for those in jeopardy, nor do their perceptions slow down. What happens is that the stress and novelty of the experience causes the brain to create extra layers of memory, a saturation effect, compared with everyday experiences. According to researcher David Eagleman, the more memory you have of an event, the longer you believe it took. So yes, time does seem to slow down in a crisis, but it is a cognitive illusion. That slowing down effect is important to bear in mind, as we encounter the 20th anniversary of the Russia LTCM financial crisis of September 1998, and the 10th anniversary of the Lehman AIG financial crisis of September 2008. For investors, those events were the financial equivalent of falling off a tall building, or being strapped in during a plane crash. If you lived through them, you will recall some hours that seemed like days and days that seemed like weeks. Of course, investors recall where they were and what they did during the absolute height of the panic September 28, 1998 and September 15, 2008. Most investors may not be aware that these peak panic moments had actually been playing out for over 15 months in both cases. Investors who closely observed the early signs of trouble had ample time to get out of the way of the panic itself. In fact, most investors were oblivious to the early warnings. That 15-month build-up was a real slow-motion event, not an illusion. The September 1998 Russia LTCM crisis began in June 1997, 15 months earlier, when Thailand devalued its currency and closed its capital account. For several years, Thailand had maintained a fixed exchange rate to the US dollar. Money poured into Thai real estate and resorts to earn high yields with an exchange rate guarantee. When some investors started to pull their money out, a run on the bank emerged. Thailand could not make good on its dollar guarantee and devalued, causing massive losses for U.S. investors. From there the panic spread to Indonesia, Malaysia, South Korea, and other nations. There was literally blood in the streets, as some were killed in money riots. Markets calmed down that winter, but the contagion returned in the summer of 1998. In August, Russia defaulted on its bonds, devalued its currency, and closed its capital account. That led to a global liquidity crisis, which caused massive losses at hedge fund long-term capital management. The Fed and Wall Street banded together to bail out LTCM, but really to save themselves. Global markets were just hours away from complete collapse when the deal was finally done. The September 2008 Lehman AIG crisis began in June 2007, 15 months earlier. HSBC had just reported weaker than expected earnings due to higher mortgage defaults in the subprime sector. In July 2007, two Bear Stearns hedge funds collapsed due to an inability to roll over their short-term financing of long-term mortgage securities. In August, the panic intensified, and the Fed cut the discount rate, the first in a long series of rate cuts, to zero. Three major money market funds sponsored by BNP Paribas closed their doors and suspended redemptions. Bank-sponsored off-balance sheet special-purpose vehicles could not obtain short-term funding. Again, markets calmed down in the winter, as sovereign wealth funds pledged billions of dollars of new money to prop up U.S. banks. But the panic returned in the spring with the failure of Bear Stearns in March 2008, followed by the collapse of Fannie Mae and Freddie Mac in June. The panic turned into a global liquidity crisis and reached an apex with the bankruptcy of Lehman Brothers on September 15, 2008, and the subsequent insolvency of insurance giant AIG. Wall Street was facing a sequential collapse of other banks, beginning with Morgan Stanley, when the Fed and Congress stepped in with trillions of dollars of guarantees, swaps, and bailout money. Both of these panics, 1998 and 2008, began over a year before they reached the level of an acute global liquidity crisis. Investors has ample time to reduce risky positions, increase cash and gold allocations, and move to the sidelines until the crisis abated. At that point there were bargains galore for those with cash. An investor with cash in 2008 could have preserved wealth during the crisis and quadrupled his money since then by buying the Dow Jones Index at 6,550. Today it's around 26,000. Relatively few investors did this. Instead, they suffered from fear of missing out as markets rose until the panic began. They persisted in the mistaken belief that they could get out in time if markets reversed, not realizing that reversals happen much faster than rallies. They held on to losing positions hoping they would come back. They did after 10 years, and so on. Simple behavioral biases stand in the way of doing the right thing almost every time. Are we in another slow-motion meltdown? Are markets telling us that another global liquidity crisis is on the way in 2019? It's impossible to know, yet the signs are not encouraging. Venezuela is an economic and human rights tragedy. Turkey, Argentina, and Indonesia, all major emerging market economies, are in complete meltdown. India, Malaysia, Brazil, and Mexico are in the midst of currency collapses. South Africa is in recession. China's growth is slowing, and its debt is unsustainable. The trade war between the US and China is starting to take its toll, and will get worse. Then there are geopolitical hotspots, like the South China Sea, North Korea, Syria, Iran, Ukraine, Taiwan, and others, that could turn into shooting wars in little or no time. Investors do not have to take an all-or-none approach. They can keep a hand in the stock market while increasing their allocations to cash and gold. Lower yield on those assets will more than pay for itself if a new liquidity crisis emerges and as bargain prices appear. The point is to act now, and not wait until reality catches up to the slow-motion perception. Harvard-trained economist, the emerging markets to bank on, and the owns to avoid. Just saw a chart with the second quarter GDP results for the fastest-growing countries in the world, and of course, emerging countries largely Asia-dominated. India topped at a whopping 8.2%, followed by waning China at 6.7%, Indonesia at 5.3%, and Turkey at 5.1%. Other notable emerging countries were struggling, with Brazil at -1.2% and Argentina at -0.7%. No surprises except the underperformance in South America. But these are trends that most see continuing. The thing is, some will perform as expected, and then some won't. And we know how this will shake out. Our longer-term indicators tell us who will grow or not in the future. And there are very different stories for these emerging countries looking forward. The table tells the future with much analysis and many graphs to back it up. Our unique analysis shows how emerging countries accelerate the most through rising urbanization, and then secondarily through rising demographics and workforce growth. Both are highly projectable. So, which country in that table can most sustain its growth for decades ahead? That's easy, India. That's why we created a special boom and bust report entitled Get Rich Off the Demographic Dividend King. It is the least urbanized at 34%, hence has many decades ahead to continue to grow in GDP per capita, which tends to triple when households move from rural to urban areas. And its trends and standard of living growth indicate it could reach $25,500 GDP per capita compared to today's $7,435, when it's 80% urban and has the largest population in the world, surpassing China. Both measures, GDP per capita and urbanization, are the lowest on that table, suggesting that India has the highest potential ahead, and for the longest time. Its trajectory of GDP per capita versus urbanization is as high or higher than China, but it will take a little more time to confirm this early-stage trend. India is the next China, especially in the next off and on global boom between 2023 and 2055. The emerging market with the least potential is, on the other hand, Turkey has the least potential. It's already 75% urban, and that trend slows down rapidly at 80% plus. And its GDP per capita PPP, adjusted for purchasing power, is already ahead of its urbanization trends due to high borrowing and overinvestment in infrastructures. That means higher GDP per capita is not likely, and may be a bit lower ahead. Remind you of China? Also, Its demographic/workforce trends are slowing, and will peak by 2040. Never mind that its government is heading in the wrong direction towards autocracy after seeming to become more democratic and Western-leaning to get into the EU, an application that the Union rejected, a political mistake, if you ask me. And the emerging market with the worst outlook is China has, surprisingly to most, the worst outlook. Even though it still has a few decades of urbanization ahead, being only at 59% today, it has overbuilt and borrowed even more than Turkey, and more than any major emerging country in history. The difference is that Turkey borrowed more from foreign sources, and more in US dollars at US rates, and so is more vulnerable in the near term. But China's crisis will follow, and very likely be the worst in modern history, when it hits. China's workforce growth was projected to peak around 2015, but already peaked in 2011, the only emerging country to experience this. So, demographics are negative for decades ahead, and overbuilding with the most massive borrowing of any major country will be a negative for the next decade. Then it will urbanize further, and grow again, but never close to 8% to 12% growth rates again. Then there's Indonesia, the third largest country in Asia. It's like Brazil, the largest in Latin America. Indonesia is a bit less urbanized than China, and not forecast to be quite as rich. But its demographic trends peak the latest, around 2055, and it has no major debt and overbuilding problems, like China and Turkey. Speaking of Brazil, it's in a temporary downturn, after major political problems. It has only demographic potential ahead, as it is already uber-urban at 87%, but those demographic trends are slowing, and peaking ahead of most of Latin America, in 2035. So, good, but not that hot in the next global boom. And its neighbor, Argentina, has similar peak urbanization, and slowing demographic trends, and a history of repeated debt and currency crisis, like now. Its currency is crashing about as fast as Turkey, from over-borrowing from foreign lenders. So, who's in your wallet? After the next crash, our research says bet on India, and more broadly Southeast Asia in countries like Indonesia, and hotter Vietnam. Oh, and I have a 160-year cycle that says the next peak in world dominance will be in the East and Asia, not in the West and North America/Europe. I expect that when the world sees mighty China collapse the worst in the coming years, they'll think the next big thing is India. We know that already, so why not read up on this topic and learn how to position yourself ahead when the next big crash hits? The country's urbanization will accelerate through massive foreign investment and a pro-business government, if its new progressive leader Modi and his principles survive.